Have you ever wondered how international trade is facilitated? It's a vast, complex world that connects economies and cultures, a lifeline for nations to procure resources, sell products, and stimulate economic growth. But at its core, international trade is simply about exchanging goods and services across borders. Yet as simple as this exchange sounds, it's not without its complexities. The distance between trading partners, the different legal systems, and the varying economic conditions all contribute to the risks involved in international transactions. Picture this: a manufacturer in country A makes a deal to sell goods to a retailer in country B. The manufacturer produces the goods, spends resources, time, and effort, only to have the retailer in country B default on payment. It's a risky venture, isn't it? The risks don't just end with the payment. There's the challenge of transportation, the possibility of goods getting damaged or lost in transit, or even sudden changes in foreign exchange rates. Therefore, it's essential to have a secure and reliable payment method to ensure that both parties fulfill their obligations. This is where international trade needs something more than just a handshake or a verbal agreement. It requires a financial instrument that acts as a safety net, providing assurance to both the buyer and the seller that the transaction will go as planned. This is where a critical component of international trade comes into the picture, a tool that has been facilitating global commerce for centuries, a tool that ensures security and reduces risk. This tool, my friends, is referred to as the letter of credit. In the upcoming scenes, we will unravel this tool, this magical letter that has been a cornerstone of international trade for so long. We will walk you through how it works, its process, and its key advantages. So stay tuned as we delve deeper into the world of international trade. This is where letters of credit come into play. So what exactly is a letter of credit? Glad you asked. A letter of credit, often abbreviated as LC, is a document issued by a bank or financial institution. It serves as a promise that the bank will cover a certain amount of money to a beneficiary, typically a seller, on behalf of their client, who is usually a buyer. It's like having a trusted middleman in a transaction, ensuring that everything goes smoothly. Imagine it this way. Let's say we have a buyer in France who wants to purchase a large quantity of specialty tea from a seller in India. The buyer and seller have never met, and the seller is understandably nervous about shipping all that tea without a guarantee of payment. So the buyer goes to their local bank in France and requests a letter of credit. The bank agrees, and the letter of credit is sent to the seller's bank in India. This letter of credit serves as a sort of insurance policy, promising that the seller will receive the correct amount of money on time. In the world of international trade, a letter of credit is a crucial tool. It provides a safety net for both buyers and sellers, allowing them to conduct business with confidence, even across vast distances. It also ensures the flow of trade, as it mitigates the risks associated with non-payment or late payment. With a letter of credit, the buyer can be sure that their money is safe until the seller has fulfilled their end of the deal. On the other hand, the seller can rest easy, knowing that the payment is guaranteed by the buyer's bank. It's a win-win situation for both parties involved. So when you think about it, a letter of credit is more than just a document. It's a bridge that connects buyers and sellers from different corners of the globe. It's a testament to trust, a symbol of security, and a catalyst for commerce. Now you might be wondering, how does this process work? Well, stay tuned because we're just getting started. Let's break down the process of a letter of credit. Imagine we have a buyer and a seller. The buyer, keen on purchasing goods from the seller, initiates the process by applying for a letter of credit from his bank. This bank, also known as the issuing bank, has the responsibility of ensuring that the buyer has sufficient funds to cover the transaction. Upon approval, the issuing bank then sends the letter of credit to the advising bank, typically located in the seller's country. The advising bank's role is to authenticate the letter of credit and forward it to the seller, confirming the buyer's ability to pay. Once the seller receives the letter of credit, he can proceed to dispatch the goods. It's important to note that the seller must adhere strictly to the terms and conditions of the letter of credit. Any deviation, no matter how minor, could lead to non-payment. After shipping the goods, the seller presents the shipping documents to the advising bank. These documents serve as proof that the seller has met the terms of the letter of credit. The advising bank verifies these documents and, if everything checks out, forwards them to the issuing bank. The issuing bank then also checks the documents. If they are in order, it reimburses the advising bank. The issuing bank then charges the buyer's account for the amount of the goods and sends the shipping documents to the buyer. The buyer can now use these documents to claim the goods from the carrier. In essence, the letter of credit serves as a guarantee to the seller that he will receive payment for the goods provided he complies with the terms and conditions of the letter. For the buyer, it ensures that his money is not released until the goods are shipped as agreed. And that, in essence, is how a letter of credit operates. What are the key points to remember about letters of credit? Well, we've delved into the basics, unraveled their structure, and walked through the process. Now let's summarize the high points of our discussion and highlight the advantages of letters of credit. First and foremost, letters of credit are a cornerstone of international trade, offering a safety net for both parties involved. The buyer is assured that the seller will meet the agreed-upon conditions, while the seller is guaranteed payment, reducing the risk of default. Secondly, they ensure timely payment. Once the seller provides all requisite documentation and meets the conditions stipulated in the letter of credit, the issuing bank is obligated to pay. This removes the uncertainty of waiting for payment and allows businesses to operate with confidence. Thirdly, letters of credit enable businesses to venture into new markets. By mitigating the risks associated with doing business overseas, they facilitate international trade and open doors for businesses to expand their horizons. Lastly, they provide a level of flexibility. The terms and conditions can be tailored to meet the specific needs of the parties involved, making it a versatile financial instrument. In essence, letters of credit act as a bridge, connecting buyers and sellers across the globe and fostering a more secure and efficient trading environment. But remember, like all financial instruments, letters of credit also have their limitations. Understanding letters of credit is crucial for anyone involved in international trade. We've demystified this topic today, highlighting its importance and benefits. But our journey into trade finance doesn't end here. In our upcoming videos, we'll delve deeper into other significant aspects like standby letters of credit, bank guarantees, and letters of comfort. So if you're keen on growing your wealth through trade finance, there's more knowledge coming your way. Don't forget to like, comment, and subscribe for more insightful videos on trade finance. Stay tuned for more wealth growing tips through trade finance.